Hi, thanks so much for tuning in. You're watching BQ Prime, and my name is Alex Matthew. Big changes afoot in the mutual fund industry, and specifically in the way that expenses are charged to you, the investor. Overnight, the Securities and Exchange Board of India has launched a consultation paper to discuss several proposals that will change the expense structure, which is described as the total expense ratio, and the way that it is formulated. Key of those changes, I will list two, and then we'll go through several other changes over the course of this conversation. The first is that so far you've had the total expense ratio, which by the way is a percentage of the daily NAV. It has so far been assigned as a scheme level ratio. It is now going to shift to an AMC or an asset management company level TER that is based on the assets under management. We'll discuss this in detail. The second is that all expenses, according to SEBI, should be included in that TER. We'll speak about the implications for you, the investor, as well as the industry. Joining me on this conversation are Radhika Gupta, the Managing Director and Chief Executive Officer of Edelweiss Mutual Fund, and also the Vice Chair of AMFI, and also Mohit, the Chief Executive Officer of Moneyfront. Thank you so much to the both of you for joining in at such short notice. Radhika, I'll come to you first. Initial responses to the proposals that have been launched by SEBI, and what is the industry likely to go back to SEBI with?
So I think the conversation about this has been happening for some time. SEBI had anyways mentioned a few months ago that they were going to do a review, and so there have been conversations going. So I think the direction of this is not a surprise to anyone in the industry. I think Chairperson has also mentioned the notion that broking costs, TER has to truly be all inclusive. So I don't think any of this comes as a surprise. Maybe some of the specifics, have been shelled out. So that is where I think the industry, will come back. I think net, Alex, if I see it as a consumer, as an investor, the cost of ownership continues to get lower for mutual funds, particularly for large size equity-oriented mutual funds. I think post the circular, cost of ownership will really get lower. I think the fact that we are including broking costs, etc., is quite unprecedented. So TER will truly be all inclusive. So I think transparency level of our industry also continues to get higher, and I think that has been happening for the last 4 or 5 years. So that's the direction we are taking. And there will be different impact AMC-wise. I think now whether you are large, mid, and small, and the circular details it out, but category-wise TER will have very different implications for different categories of AMCs.
Okay, so we'll delve a little deeper. Thank you for that overview. But Mohit, my proposal is that we look at each of these key changes, you detail those changes, and then I'll also go back to Radhika on what she thinks of each of them. The first that I want to talk about is that all-inclusive TER. This has been in conversation for some time now, but a few key points to hit there. And maybe you can spell them out for us, and then we can take this forward. So what is that change about?
Okay, sure. So, Alex, I think all-inclusive TER will mean that all your brokerage costs and transaction costs of trading, which the mutual fund AMCs typically do in terms of buying and selling stocks or buying and selling bonds, will now be a part of the TER. Till date, this was exclusive. It was over and above the TER. This might actually impact certain categories of schemes or certain categories of mutual funds very hard. Just a case in point, arbitrage category, right? Now, arbitrage is one category where there is a lot of buy and sell. There is a lot of churn, right? You buy derivatives, cash, you're doing a lot of trades on a daily basis, right? If the transaction costs are taken and absorbed in the TER, the TERs will shoot up the roof, and any which ways that category is a category of thin returns in terms of it competing against the short-term debt categories, right? So that was just a case in point, but I think the overall impact will have to be assessed. But there, from an investor's perspective, on the broader equity categories, it will reduce a lot of churn. It will reduce a lot of unwanted trades and transactions and will give more transparency. But from an AMC's perspective, I think Radhika might be able to argue more on this, but it will actually impact a lot of categories and a lot of the profitability also.
Okay. A couple more points to it before I hand it over to Radhika for her thoughts. the B30 incentive will be capped at 2,000 and will only be allowed for new investors. That's one change that is being proposed. The additional charge on schemes with exit load of 5 basis points that was allowed is proposed to be done away with. So that extra 5 basis points of charge will be done away with. And the TER should also be inclusive of GST on investment as well as advisory fees. So quite a few changes, Radhika, in this. To the point that Mohit was making on the churn in the category, and for a scheme like the arbitrage scheme, which is meant to have so many transactions, this could pose a challenge?
Yes, it will. I think in high churn categories, it will pose a challenge. So if you look at a fund category like arbitrage, now, maybe if you're a large sized AMC, just to give you some math, your total cap on TER in arbitrage is probably going to be 1.1% or something like that, if I just do the math. Your brokerage, I suspect, is going to be 30-40 basis points in a scheme like arbitrage. Your STT is going to be even larger if you do churn in the arbitrage category, and then you have GST. So it becomes a little complicated. I know certain equity schemes, for instance, which have particularly large churn on the equity side because they follow a momentum strategy or any kind of those strategies. So again, there your GST and your broking and STT will be very, very high. One thing that SEBI has given, please remember, is the option for AMCs to have direct market access and in some way house some of this broking activity. Now, certain people will take the call to do that, I suspect, and certain people will take the call not to do that because it has different requirements in infrastructure. But I think that is an option you will see some AMCs exercise because something like arbitrage could become quite difficult.
To that point, SEBI has had a carve out in the debt category of overnight funds. Is there something that could be done specifically for arbitrage funds where, as an industry, go and say, look, we have multiple transactions. That's the nature of the scheme. So can we have a carve out for that?
It could. It's not so easy because you have to remember arbitrage is done in balanced advantage funds. Arbitrage is done in equity savings funds. Arbitrage can be done in multi-asset funds. So how to build these kind of carve-outs is going to be, a little bit challenging. As I said, the likely solution is that people may use this window of direct market access. I think that's not being talked about enough. But, I think that is something that people are likely to consider because these are vanilla transactions in nature and perhaps some of them can be done in-house.
The direct market access, just to clarify, how is this done? Is there a charge involved for the fund house?
So what the paper says is that AMCs are basically allowed to become limited purpose members of stock exchanges and then take care of some of their broking activity in-house. And the principle that Chairperson had also outlined in a previous conversation was that, if you are paying TER, then, if you don't need research services for some of these things, then you can do that broking activity in-house. So if you don't want to pay a third-party broker for doing broking, you can do your brokerage by being a limited purpose member of the exchange, and that saves you that cost. Of course, you'll have to have infrastructure to do it.
Okay. And that involves cost. All right. So, but let's talk about what I was most interested in, which is that change in the calculation of TER per se. For many years now, we've had a scheme-wise classification of TER, and the SEBI's contention, even before this consultation paper was introduced, was that has led to a fragmentation of the schemes that have been introduced in the industry. Not necessarily a great thing for investors because more choices are not always a good thing. Mohit, could you take us through the key changes in this specific proposal?
Absolutely, Alex. I think what was happening in the industry was because a lower sized scheme could charge more expense ratio, there was a slew of NFOs which was coming in, which in turn led to higher commissions to the distributor fraternity and which in turn led to higher sales also. Because if you see the industry data for last whatever time frame, you will see the bulk of the sales comes through new NFOs. Existing schemes receive flows, but not to a large extent. Only SIP flow is what has been thriving in the existing schemes, right? So now, when SEBI comes out with this proposal, I think the overall the charge structure, which will be at a category level, and the categories will be bifurcated into two. One is equity category, and other is non-equity category, equity and related equity instruments. So when you aggregate the sum of all equity holdings of a particular AMC and then put the slabs, I think the overall charge structure will become fairly uniform, whether you launch a new scheme or whether you are mobilizing in an existing scheme, which is 20,000, 30,000 odd crore kind of an AUM. So it obviously gives a lot of transparency to the investors, but in turn, I think it impacts the distributor fraternity a lot. So that's what I think is going to happen now.
Yeah, I'm not sure if we're able to display the changes or the proposed structure on the screen, but in case you can't see it, for the first 2,500 crores, it's set at 2.55% for equity schemes, and then it keeps reducing as the AUM, as Mohit explained, of equity holdings of for an AMC go up. And if you have up to 1 lakh and you hit that 1 lakh threshold, just as an example, the effective rate that can be charged, and Radhika, correct me if I'm wrong here, is 1.87%. So every equity scheme within the AMC will have a maximum chargeable TER of 1.87%. The question is, and Radhika, you've already pointed out that there could be challenges in a few schemes. Are there more challenges that we've not discussed as of now?
So, optically, no. I mean, I think I've read through the paper in fair detail. I think what you will have now is, real differentiation between large, mid, and small. So that is a consequence. I mean, the theory behind this was that operating leverage and the benefits of operating leverage come at category level, because if you're hiring a team of equity fund managers, you're hiring an equity team, not a scheme level team. So I think that was the genesis of the whole thing. So you can't cross subsidize one scheme with the other. But the net outcome, as Mohit said, is that you will see TERs compress in large AMC schemes. I think mid and small ones, actually, you may see TERs even rise.
Interesting. An important clarification there is that passive funds don't fall under this, and they will continue to be charging what they're charging right now, so they don't fall under this classification. But to that point, Radhika, I just want a clarification, or rather I want to ask you the implications of this for the industry. One would assume optically that this is beneficial for the smaller players and that would improve the competition, because I would also assume that distributors would be incentivized to sell smaller players' schemes because they have a larger share here. But then on the other side, you could have the larger players gang up and say, look, why are you paying so much? Come to us, right?
I've lived life as a very small AMC. I don't know what small, big, and large is. And as a medium-sized one, I don't think these things are black and white. So people often say this will lead to mis-selling because people will sell small AMC schemes. There are lots of challenges if you are a mid and small size player. So to just assume because you are paying more in distribution commission, people will sell you, it doesn't really work that way, because there isn't a certain advantage to large size brand, etc. So I don't think the answer is black and white. Otherwise, even today, small size schemes, have the advantage of higher TER because of the current slab structure, and small AMCs don't scale up. I mean, they don't raise the kind of money in NFOs that very large AMCs raise. So I don't think the answer is that black and white. Yes, I think, the consultation paper mentions that the profit pool is perhaps skewed a little bit. So this might give some space to mid and small sized AMCs, but I don't think the answer is so black and white. I mean, there are lots of things that go into distribution and consumer choice besides just brokerage.
Mohit, before we move on, I have a couple more questions for Radhika on the calculation of this. So debt schemes also, like equity schemes or other non-equity, will have their own structure for TER. But hybrid is going to be a combination of equity and debt. Is that a simple formula for AMCs to follow?
That's tricky. That's very tricky, because if you take a category like balanced advantage funds, the net equity, and it depends on how you classify equity and debt. And different people run balanced advantage funds in very different ways. The same is true of equity savings funds, multi-asset funds, all these categories. Equity and debt levels keep changing. So does that mean that your TER keeps changing? Does that mean that your distribution commission keeps changing? I think that's something that we have to think about and work through, because the formula for hybrid schemes is just that. So in certain hybrid schemes, I think it's a lot more static. But what you will see is, I guess, hybrid TERs will come down because a certain component of debt is now factored into.
No, that's a very interesting point, and particularly I would think for schemes like multi-asset funds, where you could have a wider skew of such assets, equity, non-equity, that would pose a bit of a challenge. The next point that I want to hit is the disincentive for switching. And Mohit, could you explain how the distributors will be disincentivized?
Look, Alex, I think again it's a fairly known thing in the industry that bulk of the NFO flows, and SEBI has also put out data this time to support every argument which they're making in the consultation paper. So from April 21 till September 22, around 87,000 odd crores was mobilized in NFOs, out of which 27% of the mobilization was switches made from existing schemes of the same AMC, right? And why those switches were made, if you go to the depth of it, because the NFO was offering higher commission and switches were made from existing schemes which were at lower rate of trail commissions, right? So SEBI has actually come out with data and arguments very, very strongly in this paper. And they say that now, if you are to switch, you're free to do the switches, but the commission applicable will be the lower of the two schemes. So if you switch from scheme A to scheme B, whichever scheme is offering you lower commission on an annualized trail basis will be the one which is applicable. They are also rationalizing the way you pay trail commissions on NFOs. They're saying it has to be an increasing way up, which means if you're paying trail commissions for first 3 years in your brokerage structure, it has to be increasing for 3 years or at least equal for 3 years. It can't be that the first year commission is extremely high, which again was a very, very prevalent market practice, that the first year commission was high and the consecutive years were lower. Okay. So SEBI has made it watertight, and this will definitely stop a lot of new inflows or a lot of switches in the industry, which were happening just because of commissions.
I must point out that these are proposed and not yet notified, so we must call it that. There could be changes. Let's see what happens. But Radhika, this point, and based on what we've already discussed, for the AMC and for the industry, could we now see a consolidation? Would it be more? Would it be better to have fewer schemes rather than a large basket of schemes?
Yes and no. I've always been a believer, regardless of these regulations, that the industry has maybe a little more products than it needs. What we need, and actually quite few investors compared to the size of the potential tax-paying base in this country. So I think, there's always been a great need for simplification, and, at least we as a house have been one that doesn't like to launch too many NFOs, because the focus really should be to build up your existing schemes and take them to a wider base of investors. So I think I've always been in that camp. I don't know if that's the popular camp, but maybe you will see a consolidation of schemes, or at least you'll see schemes being launched for good reason. So I'm never against new schemes, but I think schemes should be launched for the right reason.
That's a fair point, Radhika, but my interpretation of this is that it may not be profitable for an AMC to have multiple schemes that don't necessarily have a very different approach to investing, and maybe the underlying portfolio is not very different. So
which is what my point is, that now if you want to launch a new scheme, you should really be bringing something new to the consumer. I mean, there has to be some case for it. It should not be a replica of XYZ, right? So you have to launch a new scheme for good reason.
Fair point. I want to come straight to you for this one, because it's kind of, very clear, performance-based TER to be considered. And SEBI said that there should be a reward for doing well, that a scheme should be allowed to have a higher charge if it is beating the benchmark quite consistently. They say that this is going to be sandboxed. It's going to be looked at carefully for some time. How do you think that this will pan out? Is it something that everyone can adopt?
So again, I think the paper here is just very introductory. The fact that they are introducing it in sandbox actually is made me quite happy, because I think in a retail construct like mutual fund, something like performance-based TER is a little complicated to explain to the end consumer. I also come from an AIF PMS world where these things are common, it's also a little complicated to execute. So, in a framework like Sandbox, can you try something out, enjoy the learnings and then execute on a bigger scale? I think it's a great idea. So, in a sandbox like framework, I think AMCs will be open to experimenting with it if it's something that is optional. I mean, sandbox actually is a great framework to try innovative ideas before launching them at scale.
I don't know if my interpretation is correct, but is there something that will come into play if there is an underperformance, or is there none?
No, because I think if the framework suggests that you price at a passive fund cost, and passive funds also will underperform benchmark to the extent of tracking difference. But you price at a passive fund cost, and if you happen to beat the benchmark or what a passive fund would have given you, then you can charge some higher TER. Now, hopefully that higher TER is much higher than an active fund. So you have some incentive to really go out and do that. And as I said, if it's an optionality, I'm sure optionality is always good. Optionality is rarely bad, and that too in a sandbox framework.
So among the points that I was referring to, and there are a lot of points, we may not be able to discuss all of them, but this is the last one that I want to hit. Mohit, there is an incentive that is proposed for getting women investors onto the fold. And Radhika, we were speaking about this very recently, so I'm very keen on hearing your points. But Mohit, what is the incentive that we're talking about?
Look, so exactly, I don't remember the amount which has been proposed in the consultation paper. But yes, I think what SEBI says is that there are only 27% folios with women investors out there in the industry, which is a fairly low number. And to kind of have more gender parity amongst investors and get more new investors amongst the women folk, they are wanting to incentivize or lay out some extra additional expense ratio which can be paid out to the distributors for getting new women investors. I think it is 10 bips or 1 bip or something like that, but I don't exactly remember the amount per se. But yeah, I think it's a measure in good direction, and mutual fund industry need more investors. Look, Alex, be women investors or any other kind of investors, you need more investors. You are just an industry of around 3.7 odd crore unique investors, right? So it's not a very high number in a country of 1.4 billion people. I think whatever economies of scale and whatever we are talking, we are still at a very, very nascent stage of this industry, and industry is just about coming out. So I think industry needs more participation and more incentives also at all levels of value chain to be able to get new investors.
Radhika, like I said, we were speaking about this not too long back. I'm sure you think that this is positive. Could this be the start of a lot more that can be done for women investors?
So I'm glad you came to me on this one, because I've been a big proponent of this one, and I'm so happy to finally see this in the paper. I think India's young women, in fact, if you look at the data released by AMFI, there is momentum in terms of women investors coming into the workforce and into investing and mutual funds, particularly the segment of 25 to 40. And I think just incentives drive a lot of behavior. So just bringing this to the forefront in terms of distribution incentives will be very, very powerful. A lot of people are going to make comments about the man will do it in the woman's name. It doesn't matter. At least India's women will now have, there's some incentive to have investments in a woman's name. It helps her financial security. So I think this is an amazing step. I mean, I was really happy to finally see this in the circular, and I just hope a lot more is done on this front. Couldn't be happier.
Absolutely. So we've discussed a lot of points, both of you. Thank you so much. But I do want to ask, have I missed anything? Because we haven't really had a lot of time to go through the fine print. Radhika, is there anything major, according to you, that you think I might have missed?
I mean, in a 40-page paper, after 8 hours, you'll always miss something, but I think we covered the biggies.
Okay. Mohit?
No, I think broadly, but yeah, GST being inclusive and B30 structure, B30 I think is a very, very big one. In fact, I think the way B30 structure was being used or misused or whatever you want to call it, people were breaking applications below 2 lakh sizes to make good of that 30 bips of additional incentive, right? And SEBI has now capped it completely, that only a new PAN at an industry level will be incentivized if it comes from a B30 town, and that to a cap of, I think, around 2,000 rupees per PAN. So I think it's a measure again in good direction. Inclusiveness has to be in the true spirit, and not just in letter because of a higher structure or something. So I think again, all measures in good direction for the retail investor, for the industry, and for the fraternity of distributors. Yeah, a lot on the board to think.
Yes, absolutely. On that note, Radhika, thank you so much for taking the time. Mohit as well. I'm sure that we'll be discussing this in the coming weeks as well. Thanks so much for tuning in, everybody. Do stay tuned. Lots more coming up over the course